As foreclosure rates in Nevada become the top in the country, has housing affordability finally gotten out of control to where we're going to see the big collapse? Stick around through the video and I'll talk about that and more. Good morning. My name is Adam Kahn and I'm the Rational Investor. Today is Saturday, September 30th, and I'm enjoying my day in sunny, well, not so sunny Las Vegas. Before I get into anything else, do me a favor, hit that subscribe button, hit the like button, chime in and make a comment. It really helps the algorithm that YouTube uses if you hit the like and subscribe. Doing my best to kind of grow the channel and find some new followers. I hope that the information I share helps people out and gives them good advice. Anyway, again, just before anything else, just hit those buttons and help me out. I'd really appreciate it. Thanks so much. So as we move along, I'll talk about the foreclosure rate here in Nevada, but the affordability has gotten much more than it was a few years ago. But I want all you guys to keep in mind that inflation is inflation. A house doubling in price is no different than your eggs doubling in price, or a soda, or going out to the restaurants, or gas, or anything else. There seems to be a bit of a disconnect because it's an expensive item. I get that, and I see where people would get confused, but the reality is inflation is inflation, and we've had a big increase in inflation over the past few years, which I'm sure we all agree to. The Fed's doing its best to slow it down. Powell even made a comment about no big boom cycle has ever started or been going on through high inflation, so I understand the reason to get it down. I think they've done a great job so far, but I think that everybody's a little off on what they expect to see, because I think they're going to slow the inflation rate, which doesn't mean deflation. I don't really see a big collapse in housing. Maybe we pull back another 5 or 10%, but we've pulled back some here specifically in Las Vegas. And the reality is we've just hit this point of a lack of buyer demand, but a lack of inventory, and the market's kind of sustaining itself. My guess is we're going to see this time of year after the summer where house prices begin to drop a bit. You'll get a few panic sellers because the economy's scary and they'll get nervous and want to get out of the market. And once those homes sell and those people are out of the way, the market will drift higher starting, February, March next year through the summer busy season when people are rushing to get into homes for school. That's a typical cycle of a housing market anyway, and I don't really see the big crash that a lot of people on YouTube are talking about. They have a lot of good data points, but one of the things I want to talk about is that affordability issue. Affordability to who? I understand that it's become less affordable in terms of a monthly payment to a lot of people who don't own. And I understand if they're looking at a $500,000 home from 2 years ago, comparing a $500,000 home to today with higher interest rates, how that payment has changed. But that's no different than saying stock X has gone from $30 to $60, so now it's not worth that because it costs more. I don't know that it's not worth that. And those who don't know what I do mortgages as well. And when I've had clients coming in, they qualify for the homes that they're buying. They have good jobs, their debt to incomes are in line, they have the down payments. It's not unaffordable to them, and they want to own a home. If prices go up or down, I try to make sure that people are comfortable with their mortgage payment, and that's not their focus unless they're looking for an investment property. If they're buying a home to live in and they're comfortable with their payment and they can afford it, they'll be okay, and there's really no reason that they'll become some panic seller in the future if they're just buying their house to live in. That seems to be something that people have trouble understanding. Yeah, I know that markets go up and down, but just because a market went up doesn't necessarily mean it is going to come down. Now, I'm not making a prediction. You guys need to make your own decisions and do your own research. Like, don't listen to me. I'm just some idiot on YouTube, just like everybody else. But Nevada, who's number one in foreclosures, is one out of 2,224 homes. That's super low in terms of history. So it sounds great on data points, especially when you put it into percentage terms and how much it's gone up from last year, but it's gone up from exceptionally low levels and still are. If I can figure out how to do my picture in picture, I'll put a little thing up there with a chart that shows the foreclosure rates from like 2008, 9, 10, 11, all the way through today to show where we are in terms of that scale. Now, of course, the ones that you're going to see in like 9, 10, and 11 were super high, but when you get to like the averages, I want to say there's typically, 400, 500,000 homes a year that foreclose. And we're at 183,000 or 185. Like we're still on the really low end of those numbers. It's a natural ebb and flow of the market, not some outrageously high percentage rate of homes that are in default. You know, again, I think it sounds great to say it's up 30% or whatever the number is year over year, but it's still on the low end of the foreclosure rate we'd expect to see. So are we on the verge of some big collapse? I don't really think so. I mean, I suppose it's possible because anything's possible. My background, I started out, I was a floor trader I traded currencies for the most part at the Chicago Mercantile Exchange. So markets can go crazy and they can go straight up, they can go straight down. But I think this is a legitimate bull run and inflation has gone through the economy. I don't really picture seeing gas prices down to 250 again. I don't really see house prices falling in half either. I think you'll see things go up and down. I don't think it'll be some straight line up. And we may even sit at these levels for a long time until people just get more used to it and then it catches itself and moves along at its normal rate of going up. It also might collapse, so everybody has to make their own decisions of what they think for themselves and what's best. But, a lot of other countries, when they look at home prices, they don't make sense in terms of the rents that they would receive. They may be making less than 1% versus what a home would value at versus the rate of return on a rental. People still want to own their homes. It's a sense of security, it's pride of ownership, and there are a whole lot of other things that go into it other than straight math of return on investment. I think somewhere along the lines, we lost track of that. Plenty of people are going to want to own their homes. I don't care if rents are $1,000 and the house is selling for $1 million. I mean, I think that's the case. If you go to Hawaii, at least it used to be. I don't know what it's like now, so forgive me. But I'll share a story when I was out there years ago. I love to chat with people. I tend to open my mouth a little too often, probably, and say hello. But we were taking a shuttle to whatever hotel we were staying at. And I said something to the guy driving us asking about, the housing here is so expensive. How do people who work find places to rent? And he kind of laughed. He goes, the rents don't really make sense to the prices of the home. You can rent a place for 1,500 or two. Now, this was many years ago, so I don't know what it is now in terms of what they've gone up, because I'm sure they have. But his point was, even though a house might be $2 or $3 million on paper, they're not getting the rent you would expect for that value of a home. Possible Airbnb has changed some of that and other things, but he said the people who rent out the homes generally know that the salaries are what they are and they take what they can get. I think that's the same in other countries, and I think that could be what you start to see in certain areas. COVID has changed things where there's more work at home, and I think people are looking at places like Florida and Nevada and nice warm weather states and wanting to live there. And if they can work remotely and be able to afford to live there, especially if they're moving out of somewhere like California or New York or Hawaii, where the home prices are significantly more expensive than what they were in Florida and Nevada. On top of that, for us specifically, we now have some sports teams that have come here, and it seems like we're continuing to grow. I don't know that the rents will make sense in terms of what the house prices do, but me personally, I don't see a big collapse coming. I think we'll stay slow for a long time. I don't really see that changing, but I don't really see the prices dropping like 2008. There are too many things that are different. And the main thing I'll point to is the way people qualified and the loans that are available are totally different. You had stated income. You now have bank statement programs where you have to show the deposits in the account. So people could just walk in and say, I make $1 million a year. And the lender would accept that. On top of that, you had a product called the option arm, where people could make different payments. Some of them were what is called negatively amortized, which means you're actually paying less than what the interest payment alone is, and you're adding on to the debt of the house. And lenders were using sales pitch of, well, real estate always goes higher, so what's the difference? You can refinance later on. And I hear a lot of videos about people saying that now, and I really hope that's not the case. Me as a lender, I try to really make sure people don't make that guess and that they're comfortable with the payment today where it is. Because if that's incorrect and you've prepared somebody that, oh, you can just refinance at a lower rate, and they're banking on that because they're stretching too far today, that's a huge mistake. Nobody knows what markets will do. People have their guess and they can have good guesses and reasons that they can point to it. But markets are markets and they'll go wherever they go. So to imply that rates will be lower in a year, 2 year, 5 years, it's a terrible thing to say to somebody because who knows? Things change. Anyway, with the option arm, they then matured and went into a regular, what you guys know of or think of as like a 30-year mortgage. So you could see people going from payments that would quadruple sometimes, and they were used to $500-600 payments going to 2,000, 2,400. And if the house was now upside down where the value wasn't worth what it was when they paid for it, imagine having a payment that you don't understand what it is. You're making the lowest payment, which is $500 or $600. You actually owe more on the home than you originally started with. And don't forget, you could actually take second loans for your down payment where you've put nothing out of pocket. So you put nothing out of pocket. You originally owed 100% of what the value was of the home. You now owe more than that, and your payment goes from $600 to $2,400. That's a different scenario, and somebody is much more likely to walk away from that property than they're pinned into a rate of 3% and feel stuck. And if they move, they're probably going to look at a higher tax basis. They're going to be looking at higher insurance costs, and they're going to be looking at a much higher interest rate in the loans they're looking at. I don't see what chases people out of that scenario. And then two different directions. If interest rates continue higher, even the people getting in today are going to get more and more pinned into the homes. And then if the lenders or real estate people who are saying you can just refinance in time if rates go lower, as long as house prices don't drop, because keep in mind, if the value of the house drops, you may not be in the right position to do that. That is possible too. Again, don't bank on that. Make sure you're comfortable with what you pay today. And whether it's stocks, real estate, collectibles, whatever it is, I want to own whatever I can. I just don't want to over leverage and bite off more than I can chew. Make sure you're comfortable with it and you don't overdo it. But I wouldn't be scared to get in the market either if you're in the right position. Anyway, once more, do me a favor, like, subscribe, say something, chime in. I hope you guys are enjoying your weekend. Again, my name's Adam Kahn. I'm the Rational Investor, and have a great afternoon.